to the Smart Investing Show, sponsored by the SEC registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of the investment firm Wilsey Asset Management. Thanks for joining us today. We've got a lot of things to cover today for you. We're going to talk about things such as other risk in the market that you should be aware of. We keep talking about risk, and everything's fine. Oh, things keep going up. Well, there's things you don't know about. We're going to discuss those for you. Ivy League Endowments have dismal returns because of private equity. I really thought these guys are so smart, but when you look at what they did, they ain't so smart. And then lastly is AI impacting the labor market. We'll discuss the labor market. I had the jobs report come out on Friday. We'll talk about all that. And then we got some companies to cover. Jace, what are we covering today?
Yeah, companies, I always forget this company's public, and I saw it go across the ticker tape last week. So I want to look at Planet Fitness. I don't think we've ever looked at it. I see it on the way home every day, and I'm like, I wonder how their stock is doing.
I work out, you work out, everybody works out.
Yeah, check it out. And then also going to look at Paramount Skydance. If you haven't heard, it looks like they will be getting Warner Brothers Discovery, I'm going to say at some point. Then, too, we're going to look at Old Dominion having some issues with higher oil prices. And lastly, Salesforce. Obviously, we talk about this SaaS apocalypse, I think they're calling it, right? The software situation. SaaS is software as a service.
Oh, wow.
Like the apocalypse, the SaaS apocalypse. But they reported some earnings last week that, well, they looked pretty decent. So we're going to take a closer look at those four companies. As always, break down the fundamentals, give you an idea if we think it's a buy, sell, or hold based off what we see.
Who comes up with these acronyms? You said SaaS. I mean, there was, the Nifty 50. All these things throughout history.
The
FANG. All these things.
Mag 7.
Mag 7, yeah. Who comes up with those? I wonder if they get paid for that. Probably not.
Maybe. I don't know.
Somebody says it and just sticks, I guess. But let's talk about the Ivy League Endowments have dismal returns because of private equity. We continue to talk about it because I know people still have in the portfolio. But I was very concerned when I saw the Ivy League schools, who, again, I thought were the smartest people in the room, began investing in private equity a few years ago. Well, gotta tell you, the results are in, and the returns, I'm not gonna sugarcoat it, they were terrible. The best annual return goes to Cornell, and for 4 years, from 2022 to 2025, or for the years 2022 to 2025, they only had an annual return of 5.7%, and that was closely followed by Harvard at only 5.5%. And Chase, I think you got the bottom of the rack of what they did.
Yeah, worst performer, poor Princeton here, only had an annualized return of 2.8% over that time period. And a large reason, I got to say it, for these low returns is that, as you said, the managers of these endowment funds invested heavily in private equity, as the category made up as much as 40% or more of the portfolios for schools such as Harvard, Yale, and Princeton. And the other thing I want to say to that is the returns might get even worse in the coming years because, as we said before, with private equity, private credit, it's not a real market price on an annual basis. So the fact that the returns were this poor with having that much private assets, it's a problem.
Well, and also, too, we're now starting to see some pressure on them. Was it BlackRock on Friday announced closing the fund? Or
not closing. They're limiting the withdrawals. And
right.
I love the way that they sell this. They say that the reason that, I guess it kind of makes sense to a certain extent, but this is why I just don't like private investments. They say that the reason they limit these fund withdrawals is so there's not a big mismatch and they aren't forced to liquidate positions at a bad time, costing the other shareholders. Which is true, but again, just don't buy something that you can't trade or get out of if you need the money, because that's where we're now seeing the problem of limiting withdrawals, and you want out, sorry, to help the other people in the fund, you can't have your money.
And I think all that does, and they're correct what they say, but all that does is create more selling pressure because then, well, now I can't get out. As soon as I can get out, more people say I'll get out. And then I think it starts cascading downward. More people just getting out, and it's virtually over. But people got to wait some time to get their money out.
Well, especially with the headlines. I mean, BlackRock in particular wrote down a second private loan. Now, it wasn't a huge loan. It looks like it was a $25 million second lien loan. I mean, we're talking about a fund that's billions of dollars, but it nonetheless is showing that there's some issues occurring in the private credit space. Just 3 months ago, this loan was valued at 100 cents on the dollar. Well, I think it was Tuesday, 0. No, it doesn't go from last month to 75, then 25,
Right to
then 0.
zero.
It goes from 100 to 0. And that's the big problem with this private space is you can think everything's fine until the moment they write something down to 0, and it's like, what happened? Oh, well, yeah, it's worthless.
Wow. Well, the endowment funds have tried to liquidate as much as they can, but the secondary market, as we're talking about, has been rather weak. And Yale and Harvard were only able to liquidate about $1 billion of their private equity holdings last year. I think we're only in the second or third inning of how bad things will get with private equity, private debt, these deals that were just done, and they were great when everything's going up. But now that what did Warren Buffett used to say, that when the tide goes out, you say, who's not wearing a bathing suit?
Yeah, or the king has no robe, or I forget the situation with the king.
I think
but
Warren Buffett was.
yeah, he said something about the king not having a robe.
Oh, I think the king, I don't know if he did that one, but the one with the king was where that the king is walking down naked and nobody says anything until this little boy goes, he has no clothes on.
But looking at this private space again, unfortunately, many people, including foundations, will have poor performance and probably even some losses. Again, going from 100 to 0, that's a loss of capital. That's not even a volatile asset. We always talk about the difference between volatility and risk. That's just pure risk to lose 100% of your money. And I'm going to say a day because you thought you had money and then all of a sudden it's gone. A lesson to all investors: don't get sucked into a hype investment of any type, as eventually the hype disappears and you end up with nothing but dismal returns or losses. And I just really think the big problem here, again, is all of these negative headlines. It's causing people to want to get out of these assets. And I think it's going to create situations where you're going to have a long list of people that now don't want to get into these assets because they're like, you can't get out and the performance is bad. Well, I don't want to get in. And it could create a cascade or a downfall for this private placement market.
Yeah, what's that called when the big snowball comes down the hill? Avalanche? No.
I think it's avalanche.
Yeah. And that's going to happen.
I mean, the concept with the snowball is it rolls down, it gets bigger and bigger and bigger as it rolls down the hill.
It gets worse and worse. But I think who's going to win from this is going to be the attorneys, because there's going to be so many lawsuits and people losing money and suing that person. And again, if you're in these private equity funds, first of all, if you're not in them, do not go into them. And if you are in them, try to get out first, because that door of getting out is getting smaller and smaller and smaller.
I mean, we've talked about this before, but we have clients that come over to us and they have interval funds. Again, we've talked about that a lot. Don't do that. Interval funds and these alternative investments, and they've been with us now for 5 years, and we're still not out because every single quarter we can only get 5% of what's available on that particular investment, and it's just, you're stuck in it for a long, long time. And some of the returns have just been awful for the positions that we're in. And the fees on some of them are like 3%. You're just like, wow, that's great for you. You don't have to pay out, more than 5% of the assets. You get to collect a 3% fee. And also you get to collect a higher fee off of an illiquid asset that you get to determine the market price. Talk about a winner there. It's these alternative asset managers.
Yeah. And again, Wall Street's always great about coming up with ways to make money off of you, and they always fail. I mean, we talk about it. So I've been on the Smart Investing Show for 35 years now, and just buy good quality equities, watch the fundamentals, you'll do fine. But Wall Street, forget that market fluctuation, stocks are too risky, and they come up with this. So, but let's move on, talk about other risks in the market that you need to be aware of as well. Since COVID, speculative investments have continued to rise in popularity. We have talked a lot about the risk we see in margin, crypto, private investments, and prediction markets, but now there's a new data about the increase in popularity of, I hate to say it, leverage funds and options. Doggone it, give people a break here.
Yeah, and according to exchange-traded fund manager Direxion, it looks like leverage funds and inverse funds, which I got to say can be very dangerous investments, saw average daily trading volumes of $1.41 billion in 2025, and that's a gain of more than 130% from 2024. and 250% from 2020. For those that aren't aware of these products, leverage funds, they use derivatives to try and boost the return of an asset in up markets. But again, people always want to talk about risk return when things are going up. You got to understand that amplifies the losses in down markets. And inverse funds, what they do, on the other hand, is they try and produce the opposite performance of the underlying asset. And really what these are is they're not long-term investments in many cases. They're trading tools. And again, we don't believe in trading because you could really get burned on this. I mean, you talk about, again, the NASDAQ as an example. We think it's been overpriced the last several years, but you put an inverse fund on it. I mean, shoot, you're going to be down 50, 60% if you had a doubly leveraged inverse fund. I mean, you could lose a lot of money.
And sometimes you just got to ride the down periods and know that things are going to go up and down. But again, they come out with this. And it's not just these risky tools that have surged, though, as it is projected that the average daily options volume hit 58 million in 2025. Now, that's roughly a 26% increase from 2024 and is more than double the amount seen in 2020. For comparison purposes, stock volume expanded at a yearly pace of, 10% between 2020 and 2025, while leveraged funds and options trading saw daily volumes grow at compounded annual rates of 29 and 16% respectively. People getting more and more risky, which is a bigger problem because the fall will be greater with a higher amount of risk.
Yeah, again, as I said, people love to talk about it while it's going up. But again, you put all these derivatives and you keep increasing derivatives on the upswing in the market with these leveraged funds, or on the option side of the market, just the pure options. What happens is, as you said, that fall can be a lot more nasty than people realize. And a big thing that you have to understand is part of the reason for the huge increase in the volume for leveraged funds is the total number of active leveraged funds grew by 50% in 2025. And I love this. This was the largest annual increase since 2007. Now, what came after 2007?
Gee, let me think. The Great Recession?
Yeah, and that's the problem with a lot of these financial instruments is there can be just so much risk that comes from them. And they are more complicated tools, as you said, than just buying equities. And all of a sudden, things are going fine. Things are going up. What's the problem? Whoa, what happened? Things just collapsed, and it's because of the financial tools and instruments. And I think Warren Buffett was famous for calling derivatives and things of this nature rat poison. You know, they're just things that the average consumer, the average person does not understand, but they're making money off of them right now, so they're going to keep doing it until they just get burned maybe a year, 2 years, 3 years from now.
I think he also called them the weapons of mass financial destruction as well.
I think so.
He come a couple of different things. And you know what I hate seeing? Because we watch CNBC in the morning for the financial news, what's going on. I hate seeing this commercial, and I forget the Jerry Brothers, I think it is. Yeah. It's not an option. And they show like three or four different examples where the option far outperformed the stock. Yes, it does. Where's the disclosure that how many times that happens? And it's just so wrong. And people are like, yeah, I guess I should be trading options. And I've been doing this for 45 years. Options are so risky, but people think they're fine. You got the Nigerian brothers talking about it. It's just like, no, don't do options. They're very risky. You can lose 100% of your money on an option.
Oh, yeah, yeah. I mean, it's a very dangerous approach. And the problem is people in hindsight hear about a friend making it, so, well, I guess they're smart because they made money.
Yeah.
So I'm going to try and do it too. And then you don't know what the heck is happening. You think you know what's happening because maybe you get lucky once, twice, 3 times. And I mean, I always say, I feel like I know football pretty well.
Right.
I've lost multiple times on my bets. And in the options world, I view it the same exact way. We know a lot about the financial space. I know how options work, and I just won't touch them.
Yeah, yeah. And the thing is, people don't realize that investing is for 30, 40, 50 years. It's for a lifetime. And you see something hot like an option, a prediction market, yeah, it might feel good now, but you're not doing the right thing long term. And I just hate seeing people lose money. Options, again, especially naked options. There's covered options, covered calls, which we'll use for straddles. So there's things you can use to kind of help it. You can get out of a position. But to use naked options, it is very, very risky.
Yep.
So, well, Friday we had the jobs report. So let's talk about, is AI impacting the labor market? Because the headlines look concerning, as February payrolls showed a loss of 92,000 jobs in the month. This was well below the estimate that was looking for a gain of 50,000 jobs in January. January's reading was actually 126,000 jobs, but January's reading was revised down by 4,000, while December, this was pretty bad, saw a major negative revision of 65,000 jobs and now shows a loss of 17,000 jobs in the month. I was banging my head against the wall trying to figure out what happened in December that they actually had to go that they lost 65,000 jobs.
I mean, we talked about this a lot last year, and Trump ended up laying off the Bureau of Labor Statistics head there because of the inconsistency in the labor data, and they need to get something that's more reliable. And I understand it's got to be tough, right? You're collecting a ton of data here, but I mean, to have the amount of revisions to the magnitude that we're seeing, it is a little bit concerning, and I think sometimes makes people question the accuracy of the data and how much can you trust this loss of 92,000 when maybe in 2 months it's all of a sudden, well, it was only a loss of 10,000.
Yeah.
It's tough to trust this data when there's just been so many changes.
And I try to tell people, you can't look at it month to month. I mean, you've got to look at it over time and take things with salt. Listen to what we're saying, because there's things there's going to be in here. And I know you want to talk about the healthcare employment, because I was surprised on that one, but then I wasn't.
I mean, the thing you have to understand is it's just been such a stable force in the employment situation, but it actually showed a decline of 28,000. And again, that's healthcare employment in the month of February. This was largely due to, again, you got to understand the numbers. A strike that occurred at Kaiser Permanente that sidelined 30,000 workers. And I saw them on the side of the road every time I left Fox 5 KUSI down. And like, gosh, they're out there again, huh? But the thing you have to know is that now the strike has been resolved. So this should be a big benefit in the March data, because you'll get that 30,000 coming back in. Another important factor to remember was the severe weather that likely had an impact on hiring across all sectors in the month. Now, living here in San Diego, we forget about this, but you remember the pictures, and it was freezing. You had major snowstorms. I had, family in Charlotte, North Carolina. They said basically the grocery stores, the restaurants, they were all closed for a few days. So that could have also had a pretty big impact on the labor situation.
And I grew up in upstate New York, and I remember those snowstorms, and just things shut down. If you go somewhere, you drive 15 miles an hour because the roads are filled with snow. You can't get past. You got accidents. It shuts down for a few days, so that it could be part of it as well. But the federal government did continue to show declines, as payrolls declined by 10,000 in the month, and since reaching a peak in 2024, I love this, the federal government employment is down by 330,000 jobs, or 11%. Gosh, the government is trying to finally save some money as opposed to spending so much money. Looking specifically at sectors that could be impacted by AI, information saw a decline of 11,000, and the industry has lost an average of about 5,000 jobs per month over the prior 12 months. While this looks concerning, I do believe part of this is due to AI. I think a lot of the decline is due to the normalization after rapid hiring post-COVID that led to bloated employment and waste at many companies. I remember companies saying, we don't need people, but we got to get people before there's no people to get. And they just overhired.
Yeah, I know, like Wells Fargo as an example, I think they've now had 22 straight quarters of decline in employment. Wow. That's before this AI craze started. So I think this bloated employment is now not even AI in many cases. It's like, oh, shoot, we were paying people to do nothing in our company. So maybe we should normalize to drive profits higher, not really having a huge impact from AI. It's just like an overemployed situation. Another sector, though, that could be impacted by AI / I'm going to say more likely robots is transportation and warehousing in particular. This sector declined by 11,000 jobs in February, but a good chunk of the job loss occurred in couriers and messengers, which fell by 17,000. And I don't know about you, but I'm still not seeing robotic delivery trucks out there. So again, I think this could be due to normalization or the weather, because you can't have a robot replace those truck drivers just yet. Now, you could have maybe more efficient logistics situations or systems that allows for less drivers. But again, I think this is an over-embellishment of maybe how robots and AI are impacting things. And, Jim Cramer says some good stuff, but he was talking about, oh, this is it. This is the start of the AI replacing jobs. And I looked at him like, I'm still just not really seeing that. But if you look at transportation in particular and warehousing, it has declined by about 157,000 jobs. That's 2.4% since reaching a peak in February 2025.
From what I've been reading, I do believe there's a lot of robots in the warehouses moving packages around. But I think myself and other people get very scared about, because I think these big trucks, or the UPS big truck, I think they're like 10 tons. It's just scary to see 10 tons of metal going down the road with no one behind the wheel. It's kind of a frightening thing. I think that's years away.
Well, and what's going to happen when they get to your house? Are they just going to throw the package out the back of the truck? I mean, they need somebody to take it out, or I guess have a robot in there to drive it down and put it on your front door. I mean, there's still question marks around a lot of that.
Well, remember a couple of years ago we talked about, not a couple of years, a couple of weeks ago we talked about the drones, how they're dropping packages. Well, they could drop it where your dog gets it or drop it in the pool and everything. So they don't have that down yet. And I don't know if they will get that down anytime soon. But many of the other major sectors like construction, manufacturing, professional and business services, and leisure and hospitality, well, they saw little change in the month. Overall, there was definitely not much strength in the report. It's important to remember that the employment rate is still healthy at 4.4%. That is such a low rate, and it's been there for quite a while. It's hard to get that much lower. So I'm still not overly concerned about the labor market. With that being said, as I kind of said a little bit earlier, it is definitely worth watching coming months because things will change, and you can't, one set of data does not make it. You've got to keep watching the data because it could be all over the board.
Yeah, and I think, again, we talk a lot about how people are worried about AI replacing jobs. And yeah, as we said, there's definitely been an improvement of productivity. So there has been maybe some job loss, but there hasn't been that mass replacement. And I think that is still many, many years away. I think currently the bigger problem that we have is we might not have enough workers over the next couple of years. The U.S. has a current workforce of about 171 million people, but it's estimated that 12% more people will turn 65 in 2026. And it's also estimated that about 6.3 million people will retire out of the workforce as well.
And we also have to keep in mind that the restrictions on immigration are taking more people out of the workforce. There's still legal migration coming to the United States, but it does take time to become a citizen. Looking at the numbers, the loss of the workforce from people retiring will have a greater impact than the loss of illegal immigration. People don't think about people retiring, the baby boomers.
Yeah, I mean, that's huge. I think it is something that could create a lot of problems, but, we'll have to keep our eye on it. And even not to mention people turning 65 because homes, stocks, things have done so well over the last few years. People could be retiring in the late 50s because of asset price appreciation. That could even put more strain on the workforce as well. The other thing we talk about here is in 2025, average payrolls grew by 15,000 a month. So it was a lighter year in terms of job growth. But it's important to understand if we have more people exiting the workforce, the number of jobs that must be created to keep unemployment consistent is a lower number. One area, though, that consistently comes up with a shortage is healthcare, especially when you consider the ratio of healthcare workers to those that are 65 or older. It is estimated that over the next 5 to 10 years, with the population getting older, the healthcare sector could be adding 50,000 jobs a month. So if you're, 18, 19 years old and want to have maybe some job security, healthcare might be the place for you.
Yeah, now this information does come from our website, our newsletter. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Sign up for the newsletter. You get all this information plus more. Let's move on and talk about a company. And we kind of mentioned it here, Planet Fitness, symbol PLNT. They're in the leisure industry. Kind of surprised, 10% short on the float. That's a little bit on the high side here. We do have a PE ratio of 30 versus 46.7. Price of sales 5 versus 2.3. That's above the industry, not good. You want these below. No price to book value. So that means there's no value left if you take away all the liabilities from the company. That's not good. Price of cash flow 15.7, slightly above the industry at 13.1. And they do have a good PEG ratio of 1.0. So a good PEG ratio, which says what you're paying for the future growth of the earnings. Now, the earnings over last year for Planet Fitness did look very good. They were up 31% when the industry was down 37.5%. I think that leisure industry is pretty big, so it's not just health clubs or fitness centers. There are many other things in there as well. Sales for Planet Fitness were up 12.1%, double the industry, up 6.2%. The analysts seem to love this going forward, Jace. 5-year earnings per share growth estimate from the analysts on the earnings, 24%. Wow, that's pretty phenomenal compared to a loss of 0.6% in the industry. We do also see that they do, unfortunately, not pay a dividend. The balance sheet current ratio 2.1 versus 2.5. There's no debt to equity because there's no equity, so that you got to really look at the debt and kind of decide if that's worth it or not. They do have a high intangible assets, 32% versus 15%. Net profit margin, very good, 16.6 versus 4.3. Return on equity, well, again, negative 45.4% because there is no equity. Return on invested capital, 13.5. Free cash flow is $255 million, below the industry at $606 $59 million. So I'm kind of getting mixed things here. What do we see going forward?
And I did look at the balance sheet too, real quick, just because I was curious on the fact that I'm assuming they rent out a lot of their space. I know the one on Highway Road.
Are they a franchise? I wanted to.
I don't know if they're a franchise, but
That'd be a difference.
yeah, the concern I have is, I generally look at leases, but they have total liabilities of about $3.5 billion. Capital leases, when you look at short-term and long-term, it's really only about $460 billion. The long-term debt is about $2.45 billion, and if you add the current portion of long-term debt, that's another $23 million. So you're almost at $2.5 billion in debt for this business, which could be a big problem. Looking forward, let me start with the current price. Jumping ahead of myself here. Current price for Planet Fitness, again, their ticker symbol is PLNT. It's $78.66. 52-week range. Wow, the low here, $77.01. So right near that. And the 52-week high, $114.47. Year to date, the stock is down about 28%. Over the last 5 years, the stock, you're down about 8%. You go over the last 10 years, though, wow, the stock's up 435%. So it's done well over that time period. Going forward, though, for the business, I go out to December 2027. This is a disappointment. Estimated earnings per share here, $4.09. Gives you a target sell price of just $67.89. Kind of surprised by this. Looking for earnings growth this year of 10%, and then about 21% earnings growth next year. Curious how this company is continuing to grow. I'm assuming by opening new memberships is the plan.
And
storefronts.
Storefronts, yeah. And I did look at it. They are a major franchise. It says that 90 to 95% of locations are owned and operated by franchisees. As of late 2025, it's one of the largest fitness franchises in the world with over 2,700 locations. The investment, you want to take any guess what it takes to get a Planet Fitness?
$1 million.
You're a little bit low. $1.5 million on the low side. On the high side, $5.1 million. You got to sell a lot of memberships to make that up.
Yeah, no, that's pretty crazy. I a lot of times I don't understand the franchise model. The franchisee in my mind doesn't win a lot of times. It's the franchise company that really wins. I mean, Planet Fitness, they love getting franchisees because they don't really have to do anything.
No,
just collect the fee revenue there.
And many times people don't know this, but they require, okay, so if we have cups or we have something that have our logo on it, you got to buy our cups. You can't buy your own cups. So, I mean, they kind of get that franchisee locked in on things, and it's just like maybe it is good. We never buy a franchise or company because of the balance sheet never looks good, but they really have a big advantage. And unfortunately, the franchisees have a terrible advantage.
I mean, they have to do all the operations. They generally have to take on a lot of the employment risk. I mean, there's a lot of problems there. So, I mean, Planet Fitness, I don't think I would take one as a franchisee, and I'm not going to take the stock either.
No. But when we come back, we're going to cover some other companies for you. Stay with us. You're listening to Smart Investing Show with Brent Chase. We'll be right back after this quick break. Alrighty, welcome back to the second half of the Smart Investing Show, and this is the part of the show where we talk about financial planning. For that, we bring in our financial planning expert, Harrison Johnson, the CFP. Harrison, how you doing?
Doing well.
Well, we're talking about, again, taxes because it's that time of year. Beware the tax height above $505,000. I've not heard of the $505,000. What is this we're talking about?
So this year, 2026, it's $505,000. Last year, it's $500,000. This has to do with the ability to write off state income and property taxes, the SALT deduction. I've mentioned this before, but I wanted to get into the details of really what this means. So if your income is under that threshold, then in 2026, you can claim SALT deductions as an itemized deduction up to $40,400. As your income exceeds that $505,000 limit, that $40,000 deduction gradually declines to $10,000. So it's a lost, you could say, $30,400 deduction as your income goes from $505,000 up to about $606,000. So when you're in that tax bracket as a joint filer, that's where you're in the 32% tax bracket. But on that extra $100,000 of income, because of the phase out of that SALT deduction, your taxable income really increases by a little over $130,000 on only $100,000 of income. So since you're in that 32% tax bracket, the real marginal impact of the loss of that deduction means that your tax rate's really like 42%. The other thing that's interesting about that is when you're at that income level, as you get up to that level, you just barely start to go above the 24% bracket. You just barely make it into the 32% bracket. And then because of that loss reduction, it's really like 42. So what's happening is you go from like a 24% marginal rate really quickly to like a 42% marginal rate because of that reduction as your income exceeds $505,000.
There's a lot to that, but I think people are hearing the $505,000. Is there things they can do to prevent their adjusted gross income going above $505,000? Anything they can do is like, oh, I got to get down to 505.
So this is something that you need to be conscious of throughout the year. Things that are adjusted gross incomes, all of your income. So anything that you would draw from a retirement account, interest, dividends, capital gains, business income, rental income, annuity income, Social Security income, wages, all of that stuff is included on your adjusted gross income. So it's important to have an understanding of about what those amounts are, but also throughout the year, you need to be aware of, how much you're withdrawing from certain accounts, what types of things you're selling throughout the year, because all of that has an influence on what that adjusted gross income is.
Yeah, and I know this doesn't impact a ton of people, but it does serve a broader purpose, I would say, in terms of, making sure you're aware of, I guess, those different brackets, right? You talk mainly about, the 10, 12, 22, 24, 32. So, I mean, the difference between 12 and then the 22 and then the difference between the 24 and 32 are huge jumps. And, I'm not saying you should always make decisions around that if it's still the right financial decision, but sometimes people, they'll take a distribution at the end of the year and not realize all of a sudden, boom, that could spike them, in this case, above $505,000 and create issues. So, I mean, understanding, I guess, the ramifications of these different taxable levels is just so important.
And this has to do with ordinary income. So one area that this could really trip people up on is if they're doing Roth conversions or something like that. If that's done well, it can be a good thing. But the whole idea behind a Roth conversion, for example, is you're converting money at a lower marginal tax rate than you would otherwise be in. However, if you're at that $505,000 limit and a conversion pushes you over that, right now the maximum federal marginal tax rate is 37%, but the cost of doing a conversion if your income is above that is really 42% because of the reduction of the SALT tax. So almost nobody would benefit from this unless they were doing like a massive, massive conversion of several hundreds of thousands of dollars, which almost no one would need to do because they don't have that. Normally, people don't have that much money in their pre-tax accounts. So again, it's, we can look at the tax brackets and we can say, oh, the SALT deduction, $40,000 scaled down to $10,000. Really, what does that mean, though? How does that align in the tax brackets, and what is the tax influence of every additional dollar of income that you have?
And this is why people need a fee-based financial planner, because these are things you look at and people say, yeah, I'm going to do a Roth conversion. They don't think about all these other things that go on. And the other thing I want you to comment on quickly as well, we were talking about before during the break here, was people say, oh, it's not true. The billionaires and millionaires, they got all these tax deductions. Kind of explain a little bit as we talked during the break that it's real. Yes, they get them, but there's reasons for it and stuff.
People with high levels of income pay a lot of taxes. Now, it's a completely different argument to get into, what billionaires do and don't do on the taxes that they pay and things like that, because a billionaire may or may not be a high income earner, depending on where they are deriving cash from. So I think the point is, if you are somebody who has a high level of income because you're very skilled in your field, maybe you're a doctor and you have a high level of income, maybe you're an athlete and have a high level of income, maybe you're an attorney, maybe you're an engineer, maybe you work in tech, maybe you have a lot of rental properties, so there's income coming in, maybe you have a lot of retirement assets, so there's a lot of income coming in. People who make $200,000, $300,000, $400,000, $500,000, $1 million a year, you're paying a lot of taxes. And that can be compounded if you don't understand how the tax situation works and how different income sources and assets should be structured, because you get hit on things like this. This that I'm talking about, again, 42% essentially tax rate, that's in addition to state taxes. So in that bracket, this potential person would be in the 9.3% bracket in California. So that means their real tax rate is over 50% in those income levels. So people with high levels of income pay a lot of taxes, and I mean, that's just kind of how that goes.
I think people, they get so fixated on the one-offs, right? Like Larry Ellison, for example, he's got billions of dollars in Oracle stock, and
Hundreds of billions.
oh yeah,
yeah.
he doesn't really have much income. But what he does is supposedly he borrows against, that stock, and he takes on debt. Now, you ask the average person, hey, you have this money, would you be willing to borrow against it? Most people would not, and I don't know if I would either, especially on an asset like Oracle that last year I think went up 50% just to fall 50%, and you're borrowing against that. It's a crazy approach in my mind, but that is how people like that don't pay any taxes because they're living off that asset. But I will tell you, he had paid a lot of taxes to accumulate those assets over time. But again, people will fixate on that one-off, but the broad picture is, wealthy people do pay taxes.
Yeah, and I mean, there's only like 1,000 billionaires in the United States, so there's really not that many of them. And again, that's a whole separate thing. And at the end of the day, there's people out there that are just luckier than you and me and us. So there's not a lot that you can do about that. But what you can do is take a good look at your own situation and make sure that you keep your own tax liability as low as you possibly can. So that's what it comes out to, because there's a lot more people that make $500,000 than there are who are billionaires out there.
And a lot of people, they have to borrow the money to get those big tax deductions. It'll work for like a year or two. And it is funny because sometimes we tell people, well, you're better off borrowing against your home for a line of credit or against the S block. And they say, oh, no.
That's an extremely good point going down that, because, everyday people can do that. You can pull out a HELOC. You can borrow against investment accounts. You can borrow against different types of assets, but people don't like to borrow. Well, that's what extremely wealthy people do. They borrow and they use that to create liquidity. So what that means is all their money is invested all the time. They don't have a checking account with $100 billion in it. It's all invested. So most people that you talk to are willing to invest all their money all the time. So again, focus on what you can do, because there's other situations that really don't apply to us normal people. There's nothing we can do about it anyway.
Yeah, leverage is a tool. If you know how to use it, you can do very well. But people they shut down and like, no, I don't want to have any debt. Like, that is wrong.
Mortgage interest is deductible. There you go. There's a tax benefit for everyday people.
All right. Well, Harrison, thank you very much. We appreciate it. Have a good day. Again, if you want to contact Harrison, you want a free consultation with him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or contact them through the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Send them an email, set up a time, again, for that free consultation. I think you'll learn a lot and maybe save a lot in taxes and do better on the investing side as well. Mm-hmm. So you want to do another company? Mm-hmm. Let's do a company that no one's really heard about. It's not in the news lately, and that's Paramount Skydance. You want to talk about them?
Let's look at Paramount.
Okay. Their new symbol is a PSKY, Paramount Skydance. They're in the entertainment industry. There's no shares on the float or institutional ownership here yet. They do have a PE ratio, which they did not have before, but it's 398 versus not material for the industry. Price of sales looks good, 0.3 versus 2.1. Price to book value, 1.1 versus 3.3. Price to cash flow is 10.5 versus not material for the industry. Now, they have no earnings over the last year. Their sales are down 85.9%. The industry is up 5%. They do, I guess they're still paying a dividend of 1.7%. It shows that your free cash flow payout for that dividend is only 27%. We see on the balance sheet, current ratio 1.3 versus 1.2. That is good. Debt to equity, I'll say right now, is 1.2 versus 2.2. Net profit margin is a minus 0.3. Industry a positive 7.1. We do see return on equity is flat, nothing there. Free cash flow, $222 million versus $6 billion for the industry. And there's a lot of things to talk about here. So kind of hitting the basic fundamentals. We'll have more of a conversation when you're ready.
Yeah, so current price here for P-Sky, I gave you the ticker symbol, P Sky.
Yeah.
Name of the company, Paramount Skydance, $11.99. And this stock, frankly, has been all over the place. The 52-week low here, $9.95. The high, $20.86. You go forward for this business, you out to December 2027. I'll say the valuation doesn't look bad. Estimated earnings per share here, 98 cents, gives you a target sell of $16.27. It looks like earnings are expected to climb quite rapidly as well. This year, looking for earnings growth of 48%, next year, 26%. But the big thing is the analyst range is quite large. The low estimate of 16 analysts, 46 cents, and the high $1.60.
Wow. I mean, and this company has a lot going on. And again, what's going on is that they're buying Warner Brothers Discovery. It's still Warner Brothers Discovery. And that's why these numbers for the debt, they look good now. But this is where when you're looking at investing in business, you have to know what's going on going forward. I mean, the debt they're taking on is enormous. I believe their debt, their leverage is going to be like 4.2 or something. It's huge.
To the EBITDA, correct. Yeah. And if you look at it, I mean, Paramount Skydance has a market cap of about $13.24 billion. But when they're acquiring Warner Brothers Discovery, they're going to be acquiring them at $31 a share. I believe the market cap at that rate will be over $70 billion for Warner Brothers. But the thing is, you have to add in the debt that Warner Brothers have. So it's something called enterprise value. We look at the market cap of the stock plus the debt. You're talking about a $110 billion acquisition that they're taking on to buy Warner Brothers. Again, with Paramount only having a market cap of $13 billion, they're going to have to take on debt outside of the debt that Warner Brothers has. So, I mean, taking on a $110 billion acquisition, I mean, are you going to be taking on $100 billion in debt? I mean, how much? I think I was reading here shortly, actually, that they'll have like $80 billion of debt after the transaction closes.
You know, and they say, well, you know, it's backed by Larry Ellison. You know, he's a multi-billionaire. He can back it up. But he's also a smart businessman. If he sees this going down, like, no, there's no way this is going to turn around. He's not going to chase good money after bad money. Yeah. So he'd say, you know what, sorry, we'll just let it go. We'll take a tax write-off. And the shareholders will lose all the money. I mean, and they could turn around. It's possible. Yeah. I know I saw him in an interview, which I thought was kind of flippant when they said, well, for CBS, the NFL contract comes up, I think, in a few years. And they're talking about a 50% increase. And David Ellison just kind of like, yeah, we can do it.
He said, I can't really talk about it, but we planned for it. Essentially is kind of what he said. And
he kind of flipped.
I mean, I think he'll spend whatever. I don't know how disciplined he is when it comes to capital. And, you know, the problem is he was kind of doing his own little studio essentially with Skydance for so many years. Now he burst on the scene. We don't know really how capable he is as a CEO. All we know is now he, you know, brought in new writers for billions of dollars. He, you know, brought in the UFC for billions of dollars. You know, I'm talking about the NFL, the Warner Brothers situation. I mean, he is spending a lot of money, and their debt just got downgraded to junk after the announcement of Warner Brothers. I mean, this, if it works out, it'll be a good investment most likely. I think you'll make a good amount of money off of it. But the risk that is now embedded in this stock is very high with the amount that they're spending. Things have to work out with this flip to streaming. And I'll tell you, they have great content, and that's why the potential is there. But it is a huge risk with all the debt.
And what they could do, and again, we were talking about with Harrison about the billionaires with the taxes. I mean, what could happen is that Larry Ellison could say, yeah, I'll loan you the money. And that way, if it goes broke, I can write it off. Yeah. But to give them the money, I don't think that's going to happen.
He's not going to give them the money.
Give them the money, So, and that's what people think. Oh, it's backed by Larry Ellison. He's got billions. Like, but he's not a stupid businessman. He's not going to do stupid things. And I just, again, David Ellison just keeps spending and spending and spending and building debt and building debt. And he talks about the cash flow. Well, yeah.
I mean, the cash flow better be good if you have $80 billion in debt. You got to have cash flow to hopefully pay that down, but you got to chunk that down very quickly. And I don't know. I mean, we know their cash flow machine right now is still the linear cables, but that is subsiding. And I just don't know how quickly they can get the cash flow turned on. I mean, from a personal standpoint, I'm a little upset because I like the Paramount Plus because it's like $7, $8 a month. I forget how much it is. T-Mobile pays it on my behalf, essentially. But now they're supposedly going to be merging, you know, the HBO Max and Paramount Plus, and it's like, that's not going to be $8 a month. They're going to want probably $20, $25 a month.
And I think this was a great deal at a terrible price because it made a lot of sense for the deal, get all the subscribers and so forth, but they way overpaid. they should have walked away from the table. But we'll see. And I'm going to say probably the next 2-3 years, we'll see what happens because it could. I'm not convinced it'll be around. I think it'll file bankruptcy, recapitalize, and something else will come out from it.
Yeah, I mean, we'll see 2 to 3 years, as you said.
Yeah. All right. Well, let's talk about transportation. For that, we'll talk about Old Dominion, which is what do we call these people? They're like a trucking company?
Trucking, yeah, or freight
company.
line.
Okay, freight line. That's what I was looking for. Their symbol is ODFL. They are in the trucking industry, short on the float, not too bad, but not great, 8.1%. 84% institutional owned. We do see a P ratio of 40.1, which is high, but the industry is at 61.4. Price of sales is high also, 7.5 versus 1.4. Price to book value, 9.4 versus 3.2. And price of cash flow, staying in line, is high as well, 30 versus 15.1. PEG ratio is not great at 5.1, but better than the industry at 11. Now, we do see over the last year, the earnings are down 11.7% for Old Dominion, but the industry was down 21%. Sales, they fell by 5.5%. Industry up 2.5%. 5-year growth rate from the analysts for Old Dominion is 8.8%, about half the industry is 17.6%. Now, you do get a very small dividend here, about 0.6%. They use about 25% of their free cash flow to pay that out. Look at the balance sheet. Current ratio is 1.4 versus 1.3. Finally, one thing kind of excites me. Debt to equity is 0. Company has no debt, so that's very helpful that they can really weather these storms. We do see a net profit margin. Another thing kind of exciting, 18.6% versus 2.7. Return to equity, 23.8 versus 15. We see that the free cash flow is $955 million, almost double the industry at $505 billion. So these are things. No, that probably is million. I'm sorry, it is $505 million, not billion. What do you got going forward?
I mean, I'm just kind of confused.
I know you got the confused look on your face.
Yeah, current price here for Old Dominion, again, their ticker symbol ODFL, $193.97. Year to date, the stock's been really well, up 23.7%. And I say I'm confused because, I mean, the 10-year return, I mean, I would have never guessed this. 745% is how well Old Dominion's done. You look at that 52-week range, $126.01 is low, and the high $221.63. And the big reason for my confusion, you already talked about those valuation ratios, but yeah, the forward PE, I mean, gosh, you got to December 2027, estimated earnings per share is 6. That means the forward PE is essentially 35 times, 35-ish times. We have a target sell price of just $99.60 compared to the current level, kind of $193.97. I mean, the stock, I don't know why it trades at such expensive valuations.
And I thought this was going to be a good time to look at this because with the spike in oil, gosh, on Friday, oil was up, 10, 12% just for the day. I don't know if I closed at that or not, but...
It looks like oil surged 35% this past week, which was actually the largest gain in futures trading history dating back to 1983.
Wow, that's surprising. But usually when that happens, usually the truckers will go down because the higher expense for it. But one thing people
Well, that's the crazy thing is Old Dominion was down about 8% on Friday. And it's still up 23% so far this year.
That's true. So it has a lot more maybe to go down there. But the thing, too, that people are not realizing that when they look at the futures, I believe that's only a month or so out. You look further out in the futures, 5 to 6 months, oil's still trading at around $69 a barrel.
Yeah, I would not be surprised. I mean, I do believe this oil situation at least is temporary. I mean, the concern is around the Strait of Hormuz. Obviously, about 20% of all oil consumption flows through there, and right now it is closed off. I don't think it's going to be closed off for 3 to 6 months.
You know, I was looking for it. I didn't have a lot of time on Friday, but I was looking at it. I thought the U.S. was going to have ships to guide people through the
So they're offering right now insurance, but the big problem is, well, people are saying, well, I still don't want to take my ship through there. Even if you pay me back, I don't want to die.
Well, no,
Trump has said the U.S. Navy may help guide the ships through, but there hasn't been clarity on that deal yet. So, I mean, right now the strait is still technically closed, and some countries I know are cutting off production because their storage is starting to fill up. So, I mean, that's why we're seeing these big spikes, but I don't think this problem is going to last, again, a month, 2 months, 3 months. I think there will be a resolution, maybe not on the war in particular, but around the Strait of Hormuz and oil flows. I think we'll have something figured out here within the next couple of weeks.
And I know the president just seems to work every weekend. I think some deal will come out. Something will come out over the weekend, and by Monday, this could be all resolved. Like, yeah, ships are going through the strait.
Yeah, and I think
I don't
that's
believe
the thing. If you're an energy trader, you're riding high right now in energy stocks. I'd say be careful because I think things get resolved. I mean, we talk about Russia, Ukraine, again, has been dragging on for years. But if that gets resolved, you have this get resolved. About Venezuela. I mean, you can see oil plummet back down in the 50s and kind of lose out on all those profits you may have had during this time period.
Yeah. And I did read on Friday that Iran is running out of missiles. So
Take that as you will.
and they may not have much left to do. So maybe that's what the president's waiting for. But let's move on to another company that's been hit pretty hard because they're in the software industry is Salesforce, symbol CRM. About only 2.1% short on the float side. So somebody really missed the short on that a few months ago. 84% institutional owned. PE ratio 27, which is high, but still better than the industry, which is not material. Price of sales 4.8 versus 4.6. That's okay. Price of book value does look good. 3.2 versus 5. Price of cash flow also looks good. 14.4 versus 21.3. PEG ratio looking very good. 0.9 versus 3.5. Now, we do see the earnings over the last year for Salesforce did climb by 17.8% when the industry was down 2.6%. Sales did increase by 6.4%, industry up 6.2%. 5-year growth rate from the analysts on Salesforce on the earnings is 17.2%, just above the industry at 16.8%. Now, they do pay a dividend of 0.9%, using about 22% of their earnings to pay that out. Look at the balance sheet for Salesforce. They have a current ratio of 1, half the industry at 2, so I'd like to see that a little bit higher. But the debt to equity, they don't have much debt. It's 0.2 versus 0.5. They will point out here, I'll point out here, they have high intangible assets of 59% versus 34. Danger with those is that things don't go the right way. Those could be written down, which is not a good thing. We do see a net profit margin 17.9 versus 10 for the industry, so that's a positive. Return on equity is 12 versus 17, which that was higher. We do see free cash flow. This is something very good for Salesforce. $12.9 billion versus $4 billion for the industry. So they're very good at generating cash flow, which is a big positive.
Yeah, looking at the current price here for Salesforce, again, their ticker symbol CRM, $202.11. 52-week range. The low here, $174.57. We've seen a little bit of rally off the bottom there. And the high, $296.05. Over the last year, it is still down about 29%. Year-to-date, still down about 23%. I mean, it does look somewhat intriguing, though. You go out to January 2028 now. Estimated earnings per share, $14.91. Gives you a target sell price of $247.51. Forward PE right around 13.5 times. Couple concerns I do have with the stock. I mean, you're finally finding decent valuations in these software companies, but the big thing I look at is, if we do have a slowing increase in the workforce or maybe a declining workforce, like we said, these companies generally make money off what we'll call the seats or the number of users. Right. Well, if there's less users out there, that means they're going to have to raise prices elsewhere to offset less users. The other big problem that I have with these software companies is stock-based compensation. And this is just a ChatGPT, so don't hold me to it in full. As we know, it's not always completely accurate. But
what? I thought ChatGPT was 100% accurate.
I'm going to roll with these numbers because I have seen this a couple of times. Stock-based compensation in fiscal year 2025 for Salesforce, $3.18 billion. Well, number means nothing at all, so if someone compare it to, of course. Net income, $6.2 billion. I do believe Salesforce backs out stock-based compensation from their earnings reports. So, I mean, stock-based compensation is over 50% of that. And the reason that's a problem is if the stock remains depressed for an elongated period of time, people don't want $3 billion worth of a useless stock. They're going to want the cash. And that then goes from a expense that's not reported to an expense that has to be reported. Right. And, again, we talk about Warren Buffett a lot today. He said stock-based compensation has a key word in it, compensation.
Yeah, and it is compensation. And again, with the stock down as much as it is, people might be saying, yeah, I don't want that compensation, as you said. I want true dollars that I can work with.
And if the stock bounces back, they're probably fine. But if it doesn't, a year from now, 2 years from now, if it remains depressed, I think you could see earnings compression here because they're going to have to start paying people.
And I'm not sure what would cause it to bounce back yet. I mean, it's not a terrible buy when you look at the numbers, but when you point out these hitting things in accounting that people don't see, and I always like to see a company do well.
Yeah.
But on the other hand, too, you've got to understand when you invest what's going on behind the scenes, because I'd rather not invest. And let's tell people. I mean, we're actually looking at buying Salesforce, and I think it was around 180 or something. And then you discovered about the stock-based compensation, saying, "Gosh, that's kind of risky." I mean, we could really end up not being happy with that. So we elected not to do it. Has come up a little bit from them. But, I mean, the 174, I think, was just last week. And I don't know if it's over for the software companies yet.
I don't think so. I mean, I think there's still a lot of potential for them to capitalize off AI. There's going to be winners, but there'll also be losers.
Over as far as their stock going.
Oh, I see what you're saying. Yeah, I mean, you have to remember during the tech bust, things fell, then they bounced back 20, 30%, and then they crashed again. Could that occur with this? Maybe.
Yeah, maybe it could happen. Well, there's a closing bell. Thank you for listening to the Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. And be sure to go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Sign up for the newsletter. A lot of great information there. Thanks for listening. We'll be back next week right here on the Smart Investing Show. Have a good day.